Welcome to this specialized regulatory briefing on exchange-traded funds, or ETFs. We will examine the statutory evolution and mechanical intricacies of these vital instruments. Introduced in 1993 with the launch of the SPDRS and P500, commonly known by its ticker symbol, SPY, ETFs have fundamentally transformed the modern investment industry. An ETF is a pooled investment vehicle that holds a collection of underlying securities and trades on a national exchange throughout the day at market prices. This structure effectively combines the broad diversification benefits of a traditional mutual fund with the intraday trading flexibility typically reserved for individual equity securities. Governed primarily by the Investment Company Act of 1940, the ETF landscape has matured from a single product into a multi-trillion-dollar global regulatory universe. At the structural core of every ETF is the creation and redemption mechanism, which distinguishes it from both mutual funds and traditional closed-end funds. ETFs utilize authorized participants, typically large financial institutions, who have exclusive agreements with the fund sponsor to manage the share supply through creation units. These participants exchange a specified basket of underlying securities for standardized blocks of ETF shares, known as creation units, which facilitate institutional-scale liquidity management. When an ETF trades at a premium to its net asset value, APS purchase underlying securities and exchange them for new shares to capture arbitrage profits. This activity increases the supply of ETF shares available in the secondary market, effectively driving the market price back toward the underlying net asset value. Conversely, if shares trade at a discount, APS redeem blocks of shares for the underlying basket, reducing supply and supporting the market price. This vital price alignment process was standardized under SEC Rule 6C-11 in 2019, creating a consistent and transparent regulatory framework for the entire industry. Operationally, the secondary market trading model provides significant tax efficiencies. Because most trades occur between investors, the fund avoids frequent internal security sales. The in-kind redemption process allows the fund to remove appreciated securities without triggering capital gains distributions to remaining shareholders, significantly enhancing long-term after-tax returns. This efficiency, combined with extremely low expense ratios, often between 2 and 5 basis points, provides a powerful cost advantage for both retail and institutional portfolios. However, investors must account for the total cost of ownership, including the bid-ask spread and potential premiums or discounts during periods of extreme volatility. Supervisory controls require daily portfolio transparency, a core mandate distinguishing ETFs from mutual funds. This transparency is essential for effective arbitrage activity and price stability. Compliance frameworks must integrate these requirements into written supervisory procedures, ensuring robust books and records retention throughout the fund's operational lifecycle. For complex products like leveraged or inverse ETFs, which use derivatives to amplify returns, firms must maintain heightened suitability and disclosure standards. These tactical instruments suffer from volatility decay or beta slippage, making them mathematically unsuitable for traditional buy and hold strategies or conservative client portfolios. For SIE and Series 65 candidates, focus on the intraday trading flexibility and the role of authorized participants in the creation and redemption cycle. Understand that while highly liquid in the secondary market, an ETF's ultimate price stability is rooted in the liquidity of its underlying portfolio securities. Recognizing the differences in tax efficiency and the standardized requirements of SEC Rule 6C-11 is critical for mastery of this fundamental examination topic. Mastering these complex structural and regulatory nuances is essential for achieving professional excellence and ensuring robust client protection in the financial services sector. This script was written, verified, and approved by compliance professionals at financial regulation courses. We hope this briefing has been insightful for your professional journey. The script was written, verified, and approved by compliance professionals at financial regulation courses. Please consult your official statutory references for additional details.